All right, let's dive in. Today, we're tackling mutual funds.
Sounds good.
Now, I'm sure many of you have heard of them, maybe even considered dipping your toes into that investment pool. But how many of us can confidently say we really understand how they work?
Yeah, that's a good question.
So that's our mission today, to break down what mutual funds are and how they can potentially play a role in your, the listener's, financial journey. And we're doing it by taking some pretty complex stuff and distilling it down to the essentials.
Exactly, making it digestible.
Right, so you can walk away with actual usable knowledge.
Actionable, even.
Okay, so let's just get right to it. What exactly is a mutual fund?
Well, you can imagine it kind of like a big pot of money.
Okay, a big pot of money. Where does all that money come from?
Right, so it's not just one person's money. It's actually a pool of funds from lots of different investors.
Okay, so I'm picturing lots of people throwing their money into this pot. What happens next? Where does it go?
It gets invested into different securities like stocks, bonds, that kind of thing.
Right, so it's not just sitting there. It's actively working. But who decides where that money gets invested? Because that seems like a pretty big job.
Yeah, it is. That's where the fund manager comes in, a professional. Their job is to kind of, research the market and make those decisions for the fund.
Okay, so that takes a lot of the pressure off individual investors, right? They don't have to become experts themselves.
Right. They can rely on someone who is focused on exactly that. It's a lot like hiring a chef for a big dinner. You trust them to choose the best ingredients and to make sure the final result tastes great.
That's a great analogy. So I like that idea, putting my money into this professionally managed pot. But how does that translate into actual returns for me as an investor?
Okay, so when you invest in a mutual fund, you're buying units of that fund. Think of them kind of like shares of a company.
Okay, got it. Units. And what determines the value of those units?
That's where the NAV comes in, net asset value. It's basically the total value of all the investments in the fund, divided by the number of units that exist.
Okay, NAV, got it. But how does that NAV, how does that actually lead to me making money?
Well, the NAV changes over time based on how all those underlying investments in the fund are performing. If the stocks or bonds the fund holds go up in value, the NAV of each unit also goes up.
Ah, okay. So it's kind of like a stock price, but for the entire fund.
Exactly. And of course, if those investments go down in value, the NAV goes down too.
Right, so there's risk involved, just like with any investment.
Exactly.
Now, our source material talked about different types of mutual funds. Can we break those down?
Definitely. So the first type, we call them equity funds, as you might guess from the name. They mostly invest in stocks.
So ownership in companies.
Right.
Yeah.
And stocks can be pretty volatile, right? They go up and down a lot. So equity funds, they have the potential for higher returns, but they also come with higher risk.
Higher risk, higher reward. That makes sense. What's the next type?
Next up, we've got debt funds. These guys mainly invest in bonds.
Which are like loans to companies or governments, right?
Yep, exactly. And bonds are generally considered to be less risky than stocks. They offer more stable returns.
Okay, so maybe not as much growth potential, but also less potential for big losses.
That's the idea.
What's the third type?
The third one is kind of a blend of the first two, hybrid funds. They invest in both stocks and bonds.
Okay, so they're trying to find that balance between risk and return.
Exactly.
Now, we've talked about how the NAV can go up, which is good for investors. But are there other ways to make money from mutual funds?
Yeah, so besides the NAV going up, which is called capital appreciation, there are also dividends.
Dividends, so like getting paid regularly.
Right. Some funds will pay out a portion of their earnings to investors periodically.
Okay, so there's potential for growth in the value of your units, and you might also get some cash payouts along the way.
That's right.
Now, let's talk about risk, because that's a huge factor in any investment decision. Are mutual funds risky?
They definitely carry risk. But the amount of risk really depends on the type of fund you're talking about. Like we said, equity funds are generally riskier than debt funds because stocks are more volatile.
Right, so it's that trade-off again. Higher potential reward usually comes with higher risk.
Yeah. And of course, any individual fund can be more or less risky depending on its specific investments.
Makes sense. So how can investors manage that risk?
One of the best ways, and our source really emphasizes this, is to think long-term.
Long-term, okay. What does that mean, practically speaking?
Well, experts often recommend holding on to your investments for at least 5 to 10 years, especially if you're in a riskier fund. That gives you time to ride out those market ups and downs.
Right, because over the long term, those short-term fluctuations tend to smooth out a bit.
Exactly.
Okay, so let's say someone's listening and they're thinking, okay, mutual funds sound interesting. I might want to try this out. What are the first steps to actually getting started?
Well, the first thing you'll need is a demat account.
Okay, a demat account. What's that exactly?
It's basically like a bank account, but specifically for holding investments like stocks and mutual funds. You can open one with a brokerage firm or an online investment platform.
Okay, so it's the infrastructure you need to actually buy and sell these investments.
Yep.
So once you have that account set up, what's next?
Next comes the KYC process. Know your customer. It's basically just a way for financial institutions to verify your identity, which is a standard thing for opening these kinds of accounts.
Okay, so it's kind of like security and compliance stuff.
Right.
And then once that's done, what's the next step?
The next big step is choosing a fund, which is probably the most important decision.
Right, because there are so many different funds out there.
Exactly. You need to think about your financial goals, your risk tolerance, and how long you plan to invest. All of that factors in to which fund is right for you.
Makes sense. So you wouldn't want to pick a really aggressive, high-risk fund if you're going to need that money in a year or two.
Right. Or if you're someone who really hates risk, you probably wouldn't want to go all in on stocks.
Got it. So you choose a fund that aligns with your individual needs and goals. And then how do you actually put money into the fund?
So there are two main ways to do that. The first is called a lump sum investment, which is basically what it sounds like. You put in a larger amount of money all at once.
Okay, one big chunk.
Right. The other way is called a SEI, which stands for Systematic Investment Plan. With a SEI, you invest a fixed amount of money at regular intervals, usually monthly.
Okay, so it's kind of like setting up an automatic payment.
Exactly. It's a good way to start investing regularly, even if you don't have a lot of money to invest up front.
And you can kind of ease into it that way, too.
Right. And it can actually help you manage risk a bit, too, because you're buying units at different prices over time.
Right, so if the market dips, you're buying more units at a lower price and vice versa.
Exactly. It's called rupee cost averaging.
Okay, rupee cost averaging. I like that. So to recap our deep dives today, we learned that mutual funds pool money from multiple investors, have professional managers who invest that money in various assets, and offer investors different ways to potentially earn a return. We talked about different types of funds like equity, debt, and hybrid funds, and how those cater to different levels of risk tolerance. And finally, we walked through the steps of actually getting started with mutual fund investing.
Yeah, that was a pretty thorough overview. It's great to have that foundational knowledge.
Right. And as we mentioned earlier, the key takeaway is that mutual funds can be a really valuable tool for long-term investors.
Exactly. Especially if you're looking for a way to diversify your portfolio and have your money professionally managed.
Right. But like with any investment, it's crucial to do your own research, start small, and remember that investing is a marathon, not a sprint.
Couldn't agree more. Understanding your options and making informed decisions, that's what it's all about.
So listeners, as you go about your week, think about your own financial goals. What are you working towards? And how could a tool like mutual funds potentially help you get there? And while we talked about lump sum investments and SIPs today, which one feels more aligned with your current situation and why? Thinking through those questions can be really helpful in shaping your own financial strategy.
Absolutely. Take what you've learned and apply it to your own unique circumstances. That's the best way to move forward.
And on that note, we'll wrap up this deep dive. Until next time, keep learning, keep exploring, and keep investing in your future.
Keep diving in.